The technical analysis would say you take the cup and handle when it breaks through the handle, which it has over $50, that you take the top of the cup in 1980, which was 50, the bottom of the cup, which was $4 in the 90s, and the difference is 46. You add it to the top, and that would say $96 would be the next technical resistance level, if any, or that would be the projected next place to go. And if you take a 42-to-1 ratio right now, or even call it 45-to-1, where it's averaged for the last 100 years, the silver to gold ratio, even though it's been coming out of the ground for 5,000 years, it's 16-to-1, and now it's 7-to-1, meaning it's depleting in nature. The price ratio, largely because of, in the Western world, gold's role as a monetary metal and silver's role in industry, it's average about 45-to-1. So you take gold today at 42.40 and divide by 45, and what do you get? 42.40 divided by 45 is $95. Well, isn't that interesting? That would be where it would tell you to go, where you take the top minus the bottom, which is 46, add it to the top, that would say $96. So, I mean, if you were to see silver at the end of the year at $96, it would not be crazy at all. And if you take 42.40 and divide by 7, it's going to be somewhere around $600. 605. As insane as that sounds, that would match the geologic footprint right now. So yeah, I think silver is the asset of a generation. And I want to always hammer it home. I'm not telling people to buy it to become wealthy. It is wealth. And the biggest money in the world is showing you that. The sovereign wealth funds and the central banks, who have now largely reclassified silver a critical mineral. The US government has. The EU did it in 2023. China did it, and they are restricting exports. And China, as we've said ad nauseum on your show, the second largest producer in the world, is flying to Peru and Mexico and buying doré and concentrate, paying twice what the rest of the world will, and ship it back to refine it. If they're the second largest producer, then why the hell are they doing that? Because it's worth far more than the currency used to buy it. The prices are wrong. They've never been allowed to reach full price discovery when you have the largest concentrated commodity, concentrated short position of any commodity of the 1,000 plus traded on COMEX for years. It just speaks to the why. Why would it be the largest short position in this tiny little commodity? It's not for these banks to make money, is it? Sure, they do, but is there something bigger behind it? And we've talked about that forever. So yeah, what we're witnessing right now is the inability of the players that have used the Western dominance, which is big checkbooks, big pockets of cash, to continue to suppress the price naked. It's now an existential threat. And you're seeing that. The rumor is the reason they stopped is there's one big trader who took possession and would not roll it over a stamp for cash delivery, perhaps an Asian trader who wanted over 400 million ounces of silver. Give it to me. And so, all of a sudden the cooling breaks down over Thanksgiving in one of the most thinly traded markets of all. So there's virtually no activity, but just those servers broke down. Right. So the point of it is that this signals, just like the LBMA said, sorry, it's not L plus or T plus 1, it's T plus 8 weeks. Right, we don't have enough manpower or trucks. The Western system is crumbling under their own narrative, and they are losing trust. And that ain't good when a system is completely built on trust and it starts to, as the water recedes, what's the old adage, you see...
Warren Buffett said when the tide goes out, you get to find out who was swimming without swimming trunks. Yeah.
Right. And I think that's going to be a grotesque picture before it's all said and done. And that's why I think you're seeing a different narrative unfold amongst these banks, that maybe the game is over, and survival would mean breaking ranks and covering and getting out. You see one of those European banks do that, and then the whole game just implodes as the price skyrockets, and shorts get squeezed, and they cover, pushing the price up higher. This is a big deal, and I think it's just beginning right now.
If you've been watching the markets over the past few weeks, you've probably felt
something under the surface that doesn't correspond to headlines, doesn't suit the narrative, and certainly doesn't represent the calm reassurances issued daily by financial television. I've been stating for years that the system would arrive a point where the veneer begins to fracture, where stress finally becomes visible, even to those who never glance past the S&P ticker. And now, for the first time in my career, I'm observing senior analysts, central banks, sovereign wealth funds, and some of the biggest private players in the world all acting as if they know the same thing. The game is shifting, and the scramble for real assets, not paper promises, has commenced. If you want an example of how inverted everything is observe the retail investor today. The average American investor, the so-called mom-and-pop trader, is all in at levels I've never witnessed. CNBC recently ran a segment boasting about how retail exposure to equities is at a record 55%. At the exact same time, option exposure is at record highs, and margin debt has surged to over $1.4 trillion. Consider that. The least informed participants are the most leveraged they've ever been in history. They're fully devoted at the top of a bubble, while Warren Buffett holds on $500 billion in cash, and Jeff Bezos quietly sells billions in Amazon stock. NVIDIA insiders offloading, executives at Silicon Valley giants offloading, and yet the public continues walking straight into the fire. Meanwhile, something remarkable is happening in the precious metal space. Something even more important than gold's price or silver's breakout or the daily comps action. What's happening is a narrative transition, and it's arriving from places that would normally never voice a positive word about gold. The chief investment officer of Morgan Stanley recently declared openly that the traditional 60-40 portfolio, the sacred gospel of Wall Street for half a century, is damaged. And what did he advise as a replacement? 20% gold. Review that again. These are institutions that used to say maybe 1 to 2% gold, just to appease the old guard. Now, they're telling institutions to sell half their bonds and exchange them with gold. You don't issue that recommendation lightly unless you perceive something very wrong in the sovereign debt markets. And it wasn't just Morgan Stanley. Michael Hartnett at Bank of America, whose research note costs more than some people's monthly rent, stated 25% gold. And then Jeffrey Gundlach, the bond king himself, claims that a 25% allocation to gold is not overweight. I've been performing this for 35 years, and I have never heard mainstream analysts talk like this, not once. These aren't gold bugs. They're not newsletter writers in the corner of the internet. These are the people who handle the largest pools of capital on Earth, and they're speaking like they've read the same internal memos as the central banks. And speaking of central banks, here's where things get intriguing. Since last November, over 200 million ounces of precious metals have been delivered into the COMEX, but no one can explain to you who's doing it. These aren't retail investors. These aren't small funds. These are the largest, best-informed, most well-connected entities in the world. These are the same people who stood for delivery during the gold squeeze, who emptied the LBMA inventories, who are now appearing month after month taking physical metal. Not ETFs, not futures, not options, physical. The Financial Times recently noted that only 1/3 of central bank gold purchases are being announced publicly. 4 years ago, that number was over 90%. So what shifted? What shifted is that central banks around the world have decided that secrecy is now a strategic tool. China, the largest consumer of gold and the second largest producer of both gold and silver, reveals only a fraction of what it buys. Every credible analyst assumes China owns multiples of what it asserts. They haven't been transparent because transparency doesn't serve their objectives anymore. They're accumulating metal and limiting exports, including silver exports, which should make anyone paying attention consider a very simple question. Why now? And then observe the U.S. government. After decades of mocking precious metals, the U.S. has now recategorized silver as a critical mineral. The EU performed it in 2023. China just performed it. Japan is reviewing it. Countries that once treated precious metals as relics are suddenly labeling them strategic. That shift alone should alarm anyone holding a portfolio of paper promises.
Only 2 days, well, today's day 3, I don't have the numbers yet, but 2 days into the December delivery month, and there's already been 23,970 gold contracts that have stood for delivery. That's 2.397 million ounces, and plus 8,305 silver contracts, or 41,525,000 troy ounces issued and stopped so far, and the month has just started. It's also relevant to note that in November, which I would say was not normal, silver deliveries ended the month at just under 20 million ounces, about 19.7 million, which it's really crazy because November is not a scheduled delivery month for either silver or gold. There was 1,267,000 ounces of gold delivered. Issued and stopped is the correct terminology. But, the first day, this month, the December contract, Day one, we saw 7,330 contracts stand for delivery in silver, which is 36, almost 37 million. That's more than $2 billion worth. And although it's not a record, it's close to it. April was the biggest record of just under 12,000 contracts. But to see a 2-day, that's day one, and 2-day obviously added more, but it's just insanity. We've already been 2.4 million ounces of gold and almost 42 million ounces of silver delivered in 2 days. This is the same type of volume that we've seen all year long. And, it's funny, you and I started talking about this in 2020 before anyone did. And now it's just mainstream mainstream in our business. And I think this will continue until it doesn't, meaning until stuff is just depleted. And it's becoming more and more obvious that this is an imminent deal. At the same time, you have one of, if not the largest short position in COMEX futures market, along with a massive short position in SLV, one of the largest ever. And at the time, you have the LBMA, which is running on fumes. And, it's a situation where the delivery via mechanisms are breaking down. Almost 90 million ounces have been delivered off of COMEX since October, since October 1st, 90 million. It's accelerating at a level that I don't think people understand or take for granted. And I think the way that you break that up is just to simply say that, let's make an analogy, right? For years, everyone pretended that, let's call it a cardboard box was full of cookies. There's a picture of a cookie on the outside. And the thing of it, and they would trade that. But now everyone is saying, no, I want the cookies. And people are realizing that the box is pretty much empty. And when that happens, this pretend cookie game, which you could call the derivatives, falls apart. And real cookies, gold and silver, become much more valuable. And that's why prices are rising. And why the dollar and other currencies may look weak when the truth comes out. So yeah, I think it's a big deal. There was a report that JP Morgan shifted its offices to Asia in the middle of the night, that they were told that the people had like 5 days to move their family and everything to Singapore. I believe that is false.
And if you want to grasp why silver is not just joining in this trend, but is situated to become the most explosive asset of this entire cycle, you need to examine the structural facts that most analysts decline to acknowledge. Silver has been confined artificially in a 50-year price range between $4 and $50. Meanwhile, copper, lead, nickel, zinc, and virtually every industrial metal on Earth has already escaped its multi-deadband. Copper quadrupled in 2006 to 2007. Lead quadrupled in 2007. Nickel did the same. But silver, the metal with more industrial uses than all of them combined, remains stuck. That doesn't occur naturally. That occurs because someone wants it stuck. You don't preserve the largest focused paper short in the entire global commodity system if you aren't trying to accomplish something. There is no more shorted commodity on Earth relative to its size than silver. You could line up 1,000 comps traded instruments, and silver still earns the crown for the most forcefully capped. But suppression is a double-edged blade. And, as I've stated many times, the longer you keep a beach ball underwater, the more ferociously it explodes to the surface when you finally lose your hold. The banks have been resting on this thing for decades. And now, for the first time, they're losing control. Not because retail investors are requesting physical, but because sovereign groups, the big money, are refusing to roll forward paper positions and are standing for delivery at levels the bullion banks never expected. The rumor, and it's a rumor I accept, is that one Asian group demanded over 400 million ounces of silver for delivery rather than taking cash resolution. If that is true, this is the biggest obstacle to Western price direction I have ever witnessed. And it clarifies a lot. It clarifies the holiday trading halt. It clarifies LBMA extending settlement periods from T+2 to T+8 weeks. It clarifies why the U.S. government suddenly announced silver a strategic mineral after decades of pretending it was insignificant. The truth is straightforward. The world is depleting cheap silver. China is the second largest maker in the world. Yet, they're flying to Peru and Mexico, purchasing dory bars at twice the market price, and transporting them home for processing. That's not the conduct of a country with ample supply. That's the conduct of a country preparing for a monetary reset. A country that recognizes the West is sinking in debt, and that those debts will eventually be inflated away. And what do you want to possess when fiat currencies lose purchasing strength? You want the one asset that isn't simultaneously someone else's obligation. You want the metal that cannot be printed, cannot be defaulted on, and cannot be removed by an algorithm. You want the metal that central banks, sovereign wealth groups, and the largest private players are accumulating right now. Not discussing about, not speculating about, but actually acquiring. People question me, Andy, what about all the Bitcoin publicity? Isn't that where the world is heading? And listen, I grasp the attraction, but Bitcoin is speculation. Gold and silver are fortune. Bitcoin is a digital exchange. Gold is a 5,000-year store of value. Bitcoin might rise or fall based on liquidity. But gold rises for one reason only. The world stops trusting governments. The world stops trusting debt. The world stops trusting the promises of insolvent nations. And the world is starting to lose that trust very rapidly. Look at sovereign conduct. China is restricting silver exports. India is allowing corporations to use silver as security. South Korea is openly creating reserves. The Middle East is increasing metal holdings faster than at any time in modern history. The UAE is even testing tokenized silver payments. And when you observe these changes together, it's clear. Countries are preparing for a world where commodities matter more than currencies. And if you don't accept that, watch what the U.S. government is performing, not what it's stating. The Biden administration has quietly authorized record physical entries of silver into U.S. storages. Trump's incoming advisors, including the same people linked to the Plaza Accord, are openly signaling a desire to weaken the dollar to revive us manufacturing. But here's the thing, you can't weaken the dollar strategically without revaluing gold and silver. Lowering your own currency only functions if you reattach it to something real. Otherwise, you get runaway inflation and damaged supply chains. And that is why all of this counts. Gold is being remonetized. Silver is being reintroduced as a monetary metal. Critical mineral lists are growing. Treasury yields are climbing because the world doesn't want U.S. debt anymore. The repo market is showing the same warning signs it did before Lehman and before the 2019 liquidity event. And the biggest financial institutions in the world are informing their clients, not politely suggesting, but informing them to place 20 to 25% of their holdings in gold. That is not modest. That is a neon signal flashing, we are entering a new monetary era. Now, let's discuss about price. Not because price matters fundamentally, but because the math is shouting that the old levels don't apply anymore. If you're a chart specialist, the silver chart right now is one of the most attractive setups in modern financial history. It is the largest cup and handle formation I have ever witnessed. The cup is 50 years wide, from the $50 high in 1980 down to the $4 bottoms in the 1990s. A 46-point cup. The handle formed when silver oscillated between the high 40s and low 50s earlier this year. And once silver broke above $50 resolutely, classical technical analysis provides you a projection. Add the height of the cup, 46, to the breakout level, 50, and you get $96. That is just the first target. Now apply the 100-year average gold to silver ratio of 45:1 to gold's current price near $4,240, and you get, wait for it, $94 silver, almost the same number. The math joins, and if you apply the geological ratio, not the price ratio, 7:1, the actual extraction rate, silver should be worth over $600 an ounce. People laugh at that number until they remember that in 1979 to 1980, silver tripled in 60 days. Not 60 weeks, not 60 months, 60 days. That's what happens when a suppressed market finally reaches a breaking point. And here's the part no one wants to say out loud. Silver may overshoot. It may not stop at $96. It may not stop at $200. Because once a market that has been artificially kept underwater for decades snaps, you don't get a polite, orderly repricing. You get a tantrum, a violent reversion. And silver has 50 years of suppressed energy sitting beneath that cover. And this time, unlike 1980, unlike 2011, the big buyers are not hedge funds or retail traders. They are nations. They are sovereign wealth groups. They are central banks. They are industrial giants preparing for supply chain nationalism. They are entities that don't trade in and out. They buy and they hold. Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.